Most people lose money in a market crash for one simple reason. They wait until it's already happening. By the time fear hits the headlines, the damage is already done. But smart investors? They prepare before the collapse even begins. In this video, I'm going to show you exactly how to position your portfolio before a crash, what assets actually protect you, and how to turn market panic into opportunity. Every major crash follows a pattern. Let's look at history. 1929, the market dropped about 89%. 2008, down roughly 57%. 2020 fell around 34%. 2022 pulled back nearly 20%. Different causes, but the same behavior. Fear, selling, flight to safety, recovery. And that leads us to the three phases. Phase 1. Collapse. Stocks drop quickly. Liquidity dries up. Panic begins. Phase 2. Flight to safety. Money moves into safer assets. Bonds, gold, and defensive stocks rise. Phase 3. Wealth transfer. Assets are cheap. Smart investors buy. Recovery begins. Most people only react in Phase 1. The goal is to prepare before it. 1. Gold and gold miners. Gold holds value during uncertainty. Mining stocks can amplify gains when gold rises. 2. Long-term treasury bonds. When markets panic, money flows into safety. Government bonds often rise as interest rates fall. 3. Farmland, real assets. Food demand never disappears. Hard assets retain intrinsic value. 4. Consumer staples. These are everyday essentials: food, hygiene, household goods. Companies in this sector tend to remain stable and pay dividends. Understanding this is critical. Deflation. Prices fall. Cash becomes more valuable. Bonds perform well. Inflation. Prices rise. Cash loses value. Gold and real assets perform better. Different environments, but the same principle. You need the right assets for the conditions. You don't wait for the crash. You watch signals. 1. Yield curve inversion. A strong early warning sign of recession. 2. Credit spreads widening. Indicates rising financial stress. 3. Rising unemployment. Confirms economic slowdown. When 2 to 3 of these align, things can move fast. Instead of guessing the bottom, you scale in. If market drops around 10%, start buying quality assets. If it drops around 20%, increase your positions. If it drops 30% or more, this is where major opportunity appears. The key is discipline, not emotion. Waiting for confirmation from the news. Going all in too early. Freezing during the crash. Chasing risky assets instead of quality. The goal isn't to predict the next crash. It's to be prepared when it happens. Because while most people are panic selling, prepared investors are positioning for the next cycle of growth. If you found this helpful, subscribe for more strategies on building and protecting wealth.